bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 26th, 2023 podcast. In today's show, we're going to cover developer-prepared financial forecasts. This episode is another installment in our recurring So You Want to Be a LIHTC Developer podcast series. This series is geared towards helping real estate developers learn more about building affordable housing using the low-income housing tax credit along with private activity bonds. The low-income housing tax credit, often called the LIHTC, is the most successful federal incentive ever to build and renovate affordable rental housing. Simply put, without the incentive, LIHT supported affordable rental housing does not generate sufficient gross revenue to be financially viable. This episode is the first of what we envision will be multiple episodes discussing developer-prepared financial forecasts. Today, we're going to cover some of the foundational elements of financial modeling and some of the common errors or oversights that my guest sees in these financial models. In the future, we're going to build out this episode by discussing additional common oversights and errors, as well as opportunities to generate more accurate financial forecasts that benefit all parties involved. Now, today's episode is aimed primarily at developers of low-income housing tax credit and private activity bond financed housing. And more narrowly than that, those who are previously or in the process of determining the financial viability of a given affordable housing development or redevelopment. Now, a financial forecast, I may be stating the obvious here, is used to assess the expected financial feasibility of a particular development, as well as to monitor the ongoing viability of that development. This is achieved by making a range of assumptions or estimates and then calculating the project's projected sources and uses of cash flow based on the assumptions or estimates. Now, this podcast is focused on the developer and those developer-prepared financial forecasts or projections. But I also want to note, I really want to emphasize that tax credit investors build their own financial forecasts as well for the properties that they're considering investing in. Now, most of our developer clients do incorporate in their financial forecasts many of the schedules that tax credit investors are most interested in, such as a schedule of projected investor benefits and rates of return. We also encourage our developers to include such schedules as well. In that way, they have a better understanding as to how the investor is viewing their particular investment. And by doing this, the developer can negotiate better terms with the investor, and the developer can better understand underlying terms of their agreement with the investor. Now, those who've heard me speak about financial forecasts before will know that I always say there's one thing that is true for every projection and forecast. What is it? Well, the projection forecast won't be true. Actual results will vary from the forecast. A tax credit forecast is an attempt to estimate what will happen over a 15 to 18 year period. Obviously, no one can predict that with certainty. The goal of a financial forecast or projection is to be close to what actually happens, as well as to ensure that it's reflecting the actual underlying agreements among the various parties. We want the goal, or I should say the goal of the forecast is to adequately represent the ongoing cash flows and financial benefits of the investment. I also like to say and remind developer clients, even though they probably don't need to be reminded, no two properties are the same. Each property is unique and brings its own benefits and challenges, and financial forecasts are a way to package the unique data given in differing property investment opportunities into a somewhat standard format to better illustrate the expected performance of a given local tax credit transaction. Now, for those in our audience who are listening today or are watching the show on YouTube, and you want to hear more about the factors to take into account in some of the common errors and oversights of financial forecasts, and have other thoughts about or goals to maximize the financial benefits from your transaction, Novogradac does have a Housing Tax Credit Conference coming up in Las Vegas, November 30th and December 1st. I should also note, if you're listening to this on Tuesday, since it is Tax Credit Tuesday, later this week, tomorrow through Friday, we will be in New Orleans with a similar conference. If you're interested in learning more about either Tax Credit Conference, you can get details by using Google. Just Google Novogradac LIHTC Vegas, or you can also Google Novogradac LIHTC New Orleans, and a link will pop up. I'll also include a link to both conferences in today's show notes. And we're very fortunate to have joining me for today's discussion about developer forecasts, Miao Xue. Miao is a partner in Novogradac San Francisco office. And on a personal note, let me share that next year will be Miao's 20th year with Novogradac. We're proud to have her as a partner at Novogradac. Miao is one of Novogradac's leading experts in financial modeling and consulting with respect to multi-state tax credit transactions, as well as rural energy investment production tax credit finance facilities, historic tax credit properties, and new market tax credit financings. And beyond that, Miao also has clients beyond tax credit supported real estate and rural energy, including commercial and market rate residential real estate properties. And this includes focusing on opportunity zones and real estate investment trusts. Now we have a lot to cover today. So if you're ready, let's get started. Miao, welcome to Tax Credit Tuesday for your first time.
Yeah. Hi, Mike. Thank you for having me.
I really appreciate you joining me on the podcast today. And before we dive into today's topic on financial forecasts, I'd like for you to share a bit more with our audience about your background and the types of financial forecasting services you provide to clients.
Yeah. So I'm a tax partner in San Francisco office. Like Mike said, next year will be my 20th year at Novogradac. It's great to be here. So I do lots of financial forecast and in different industries like affordable housing, renewable energy, also in like non-tax credit area. And then, financial forecast is a very powerful tool for the developers, especially in the affordable housing area. It's a powerful tool for the developers to use to initiate the conversation.
Great. Thank you for that. And we're happy to have you on the show. So the financial forecasts, as we discussed and preparing for the podcast, have many dimensions and complexities. And any listener that's seen a financial forecast for a local tax credit finance transactions know there are many, many schedules, more schedules that we can cover in the course of the podcast. But in preparing for the podcast, you divided the schedules into 4 major categories. And I thought you did an excellent job of explaining what those 4 major categories were and how it logically kind of flowed. So maybe you could share with our listeners what you see as the 4 major categories of schedules, then we can jump into each of the 4 categories.
Sure, Mike. So like when developers is ready to set up a forecast, the first thing they will need to do is to do the development budget, because that's on cash basis, to talk about all the uses, all the cost. And then the very natural schedule is also on cash basis, and its sources and uses. Because when you have development budget, how can you fund the cost? And when you have an operation, how do you fund the expenses of the 15-year operation? So that's a source and uses schedule. It's also on cash basis. So after these 2 cash basis schedules, to feed into an investor benefit schedule to calculate investors' internal rate of return, you would have the tax aspects to be added to the cash components. So the third schedule will be the income and the loss schedule. And then to come up with the income and loss schedule, naturally, you're going to focus on depreciation and interest expense rules. And then the fourth one, so once you have this taxable income and loss schedule, the very next schedule is how to allocate that among the partners. So that's the allocation schedule and the 704B schedule.
704B. I'm sure
Yeah,
our
right?
listeners are thinking, I can't wait until we get to talk about the section 704B schedule.
Very exciting.
But it is a critical schedule, and we'll get to that. But let's go back to the beginning, where you mentioned of the 4 schedules. Number 1, prepared on a cash basis, the development budget. if I'm a developer, thinking about this development budget, I know it's going to be, basically what I think and anticipate all my sort of construction costs and the rest, as well as various source, construction and permanent financing are. And, I have to bring them into balance. That's a pretty basic, concept of this number one development budget in your four major categories. I know in your review, you review lots of developer prepared forecasts, and there are many sort of common errors or oversights that you see when you work with developers. In preparing for the forecast, you identified many such areas that warrant probably particular attention. We have limited time on the podcast, so I would ask you to share maybe your top 3 or 4 areas that a developer should be aware of in reviewing their forecast. And I'll have you back on the podcast to discuss some of the other areas. I'll just let our listeners know in all 4 of these major categories, I'm going to ask Miao to discuss 3 or 4 major ones, and then we will have her back to go into a little bit more detail. So think of this as a 101 on developer errors and oversights and the rest, and think of the next one might be a 201 and maybe a 301 in the future. So Miao,
Sure.
that intro, if you could share, 3 or 4 of some of the common areas that you think developers should pay particular attention when they're preparing their financial forecasts.
Sure, Mike. So like you mentioned, development budget typically has 4 components, 4 major components. One is acquisition costs. Second one is rehab hard cost. And the third one is soft costs. And then the fourth one is developer fee. So maybe I can touch base one common pitfall, common oversights in each one of the 4 categories for today's show.
Okay. Sounds
Okay.
good.
Yeah. So in the acquisition side, especially for an ac rehab deal, like the one common oversight is the breakdown between land and building in the acquisition cost. So sometimes developer would put a number split between land and building, 20/80 or something, and then later on they forgot, or the final appraisal that to support the audit, FCC audit process came up, and then it turned out to be a different split. So then all the numbers in the financial forecast, the numbers will change, and then it would lead to adjusters, which we're going to discuss in the next podcast. So that's one area. So when the developer is putting together this development budget, one key item is just to talk to the appraiser ahead of time, or just keep a live dialogue with them to make sure that they have an accurate land and building split built into the appraisal report instead of wait until the end. And Novogradac has a valuation arm, and we have a team, multiple teams who are working on appraisal reports. So you can reach out to us. We can get you to the right professional. So that's the first one. So the second one is the rehab hard costs. And this one, typically the investors would get it, developers would get it from the EPC contractor as the hard cost budget. And then in that part, I'll touch base on one component is many cases, the development, the EPC, the construction contractor detailed budget didn't have enough details to break down between site work, building, and FFE. They probably would have a very loose term when they put the items into those categories. It's hard for the developers to say which part is site work, which part is FFE. The reason behind that, this is important to have a detailed, accurate breakdown. They had 2 reasons. One is depreciable life is different. It's different, and also bonus depreciations. Site work and FFE can be eligible for bonus depreciation, but buildings can't. And then if there's a need to reach a depreciation goal in the first couple of years, then it's important to have a pretty accurate or a good breakdown between those items. And then one thing to get is to do a cost stack report. And then in that case, especially the ag rehab, you could do an acquisition cost stack, so you can break out the component of site work and FFE and take bonus depreciation in that piece. And if this one's not done, then you're going to probably leave money on the table. So that's the rehab buckets, rehab hard cost buckets. And then in the soft cost buckets, I want to touch base on the capitalization of interest costs. So that's especially for 4% deals, so the bond deals, there are lots of loans, right? Because bond deals, you have bond and you may have a construction piece, and you may have all kinds of soft loans. You got loans from states, or you got things from county, city. So all those loans, they have different, and you may have acquisition loans, you may have rehab loans. So all those loans generate interest expense. And if you have a rolling rehab, which means you have tenants leaving the projects during the construction period, then you would have run into, okay, which part is related to operation, which part is related to construction. And if the perm loan conversion is after the placing service for depreciation, then you would need to say, okay, which part of my interest expense is post placing service needs to be expensed, which part is before, and that part, which part is acquisition, which part is rehab. So this very complicated concept. So in that part, when the developers are doing the financial forecast, they will need to set up a very detailed schedule to capture all those components. And there's one area is there's the election, is 266 election. And then developers should consider that election, because that may help them capitalize more about acquisition loan related interest.
Good, thank you for that. And I guess the fourth one was developer fees.
Yeah, the first one is developer fees. And developer fees, of course, we all know like developer fee has a state limit. So read the QAP. And then more importantly is it's also focused on the ag rehab deals, developer fees. Certain portion would be allocated to the acquisition piece, and a certain portion will be allocated rehab piece. This will have a difference because if this project's in a DDA or QCT area, the rehab piece can get a 30% boost, but the acquisition piece can't. And often chances the develop fee agreement didn't have a detailed breakdown. So it would be difficult to say which part is acquisition, which part is rehab. When the developers set up the financial models, they could think about this and discuss this with their legal team and try to fine-tune the tasks that developers are performing to group them into two categories, the acquisition related and rehab related. This is going to resolve lots of discrepancies.
Well, that's a good point about they're all good points, but when you mentioned the notion of having the developer agreement be more specific about various like the allocations and the rest, because just in general, with all of this, whenever you're entering into agreements, the more specific you can be with respect to allocations and the rest, the easier it is to support whatever ultimately the allocations are, both initially for your auditors, like you and me,
Right.
as well as ultimately the IRS that they come in and audit. And you mentioned the developer fee agreement. Many state agencies, as you know, also have their own rules about how the developer fee needs to be allocated between acquisition and rehabilitation. And I've always been of the opinion that if you're buying a property to renovate it, the developer fee is all about the renovation, not an acquisition, not to buy the property, but it's about the renovation, such that it all ought to go into rehabilitation or renovation, but not all state agencies agree with that.
Yeah, right.
But there's so much more we could talk about on, this area with respect to the development budget. So we, as I mentioned earlier, we'll have you back to go into some of these other areas, to go into these areas in more detail. So we have the development budget for the actual construction phase, if you will, the development phase up until the property, the permanent loan funds. That's that initial sort of kind of short-term cash flow schedule. And the interesting thing about these 4 categories that you mentioned is that they're all iterative. So you really do one, you do the next one, you do the next one, you do the next one, you come back. This iterative
Exactly.
aspect of these schedules, which is why we're so glad that we have Excel and to do a lot of this so that you can deal with that iterative aspect. But step 2 is once you're working on the budget for sources and uses during the development phase up to permanent loan funding. And then you also have to have a schedule for the full 15 years of the investor's investment. And as listeners know, you claim the tax credits over 10 years, technically 11 years, because the shortfall in year 1 credits based upon leasing up of the property are claimed in year 11. So you really have credits over 11-year period. And then the compliance period is 15 years. So the standard sort of projections have, your development phase, your 15 years of operations, and then in year 16, some sort of disposition analysis oftentimes, which is why earlier I said the overall period of time you're measuring is 15 to 18 years, taking into account the construction phase and all the rest. When you're looking at the cash flow sources or the cash flow net operating income schedules, what are some of the common oversights or discrepancies that you see?
Right. So I want to break this into 2 categories in this
Okay.
area. The first part is initial closing. So source and uses upfront closing. So when you have development budget, what kind of sources you're going to support to fund the cost. So that's the first category. Second category, I'll talk about some, maybe 1 or 2 of common pitfalls about the operating sources and uses when the deals were placed in service and that the 15-year waterfall
Mhm.
schedule. Okay. So go to the first category when we talk about the initial closing, and it's actually 2 things that they're commingled together. So for one is developer want to identify all the possibility of the funding sources to bridge the gap, such that this deal will pencil, it will have feasibility, right? So they probably want to think about all the local sources, like the state funding and county city fundings. And one area is just to read through those agreements, because they may have additional compliance requirements, and don't miss that, because that may come back to affect you in certain ways in the future. And then on the other hand, so when developer try to find enough funding sources, one area they would just to be cautious is just to make sure you do enough budgeting. You try to avoid oversourcing, because state agencies, they are going to review the feasibilities, and that's what they're supposed to do when they review the 8609 placing service package. And then I think in most of the FCC reports, like they would have a gap funding area. So like you're going to get the LIHTC. The credits you can get is lower of 3 numbers. And then for the bond deal, you'll be lower of 2 numbers. For the 9% deal is lowest of the 3 numbers. So it's either your carryover credits, those were the allocated credits for 9%. For 4%, you don't have that. The second one is the credits can be generated by the qualified basis, which depends on your development budget, the actual basis component of development budget. And the third one is how much credit you need to bridge the gap. So it's the gap funding feasibility analysis. So developer needs just to make sure they understand the whole process and find the sources and the right amount of sources for the deal to avoid oversourcing and to bridge the gap, to avoid the gap as well. So that's the first category.
Okay.
And the second category, which is during the operation, like the 15-year operation side. And in that part, there are lots of things to talk about, but then one item is probably the waterfall, like cash flow waterfall. So when developers set up that source and uses waterfall for the 15-year credit, they would need to read through the partnership agreement, make sure they understand what they signed off, they agreed to, who gets what in what order in normal operations and also in capital event. So operating agreement right now can be like 200 pages long. Sometimes it's maybe 300 pages long. You just find the right term. They may have an operating cash flow waterfall. They will have a capital event waterfall. And the developers will need to go to the section to understand what's the definition of capital event, because sometimes they may not be what they think is what is capital event. So you need to follow different waterfall. And there's another one, which is the liquidation waterfall. Which one will take priority? Which one will be followed under each situation? So developer needs to really be familiar with the LPA, the waterfall terms, to be able to set up an accurate waterfall schedule for this operating cash.
Great. Thank you for that. And I know we have other items that we'll have for the next podcast for the 201, if this is the 101. So we talked about the development budget, and you talk about sources and uses, and like a breakout in terms of the sources and uses, kind of that initial closing during the development phase to permanent closing, and then sources and uses sort of after that, net operating income, debt service, things of that nature, and then the cash waterfall on a disposition scenario. And now let's get to the tax side. This is a tax motivated investment for the investors. They're investing for tax losses and tax credits, obviously principally the tax credits, but they also will get higher after tax yields by being allocated tax losses, which are principally being driven by a depreciation in potentially accrued interest. So if you could talk about the third category of your breakout, which is taxable income and loss schedules, along with depreciation interest expense.
Yeah, sure. So in this third categories, I think there's three big components. One is just the NOI, so it's net operating income. So in that part, because the taxable income starts with cash, right? Then you convert to tax. So taxable, you will start with NOI or EBITDA, that's what they call it. And then developers want to maximize the rent, the potential rent, but within the maximum rent limit. So in that part, developer probably need to, they just one powerful tool they can leverage on is Novogradac has this rent calculator. This rent calculator has a good summary of the historic data of each county, or what's the maximum rent limit, and it could project it out. I think Thomas probably had a better idea, like 2 years, 3 years, or certain area, certain period. So if developer could get an edge on that, so their forecast will be more accurate, and then this will have the developer will have more bargaining power at the table. The first part is to get accurate rent, and the second part
actually interrupt you there on the rent, because I totally agree with you in terms of the rent limit. The developer needs to look at the rent limit, and obviously can't charge more than the rent limit. The market study will determine if the market supports that rent limit. Developers might also want to be renting the tenants at an even lower rent limit than what they've agreed to for tax credit, to apply tax credit rules, as well as state agency rules, as well as other soft financing and the rest.
Yeah.
And as you're looking at a development, when you mentioned Thomas, our partner, Thomas Stagg, he can go in and give you an estimate as to what the maximum rent limits would be a year or two out.
Yeah.
And that can be helpful from a financing perspective, in the sense that you might be expecting notable increases, in which case the property can support more debt and the rest. Conversely, if you look at an area and it's not likely to have rent increases, well, that's unpleasant news from the standpoint of sizing your debt and the rest. It's news you need to hear, so you don't have a problem.
Yeah, exactly.
Which gets back to the forecast is about being as accurate as possible. So I would definitely encourage listeners to avail themselves of the ability to get income and rent limits a year or two out for purposes of this underwriting. But with that, back to you, Miao.
Yeah, that's a very good point. So now we talk about the rent. The next one about the NOI is to control operating expenses. We can divide the projects into two groups. One is, this is the first project in an area. And second, this is a multiple project. One of the future projects, they have existing projects there. So their operating expenses estimates or assumptions are more reasonable or align with the accurate numbers. But then if it's their first deal in an area and they didn't have resources to have a benchmark, what should be the reasonable operating expenses when they put together a financial forecast, if they just draw a blind line and just throw numbers in, they could be far off. So one tool they could use is Novograd published this annual, I don't know if it's annual or every other year, it's this operating expenses analysis report. So we show the operating expenses per unit on average in a certain area of the country. Is that the case,
Yeah.
Mike?
It's generally annual, but there have been times when there were sort of gaps in data collection and the rest, but the goal is to be annual.
Yeah, because there are many chances when I look at the developer prepared financial forecast, I would ask natural question. I would say, where did you get this per unit per year property tax per unit per year utility cost? Like, if you just say it's a wild guess, then maybe it's going to be off because lots of numbers are really building built on this NOI number, like the debt service ratio, how much debt can the project support, and also how much cash can you distribute to the investors on annual basis, what the split of back and cash, whether they still can satisfy their Chinese economic substance test just from cash perspective. So this is all important. And then so that's the first category. And then now we go to the other two, which is two bigger categories. One is depreciation, one is interest. So for depreciation, there are lots of things to talk about. Developers would need to think about, okay, should I do take bonus? Should I elect out of bonus? Should I take bonus or elect out of bonus in certain asset class but not the others? Should I do ADS? Do I have tax exempt use property issues? Because we have a nonprofit partner, and then you have to look at the tax exempt use rules related to depreciation. And if you have projects in U.S. territories like in Puerto Rico or in other areas, then you have to think about, okay, did I satisfy those exemptions such that I can take the makers, I can take bonus. So there are lots of rules related to depreciation. And then if developers are not familiar with those detailed nuances, there could be pitfalls. Like you may realize all of a sudden, oh my God, I need to take ADS. I can't take any makers.
Right. No, those are good points. And even like with bonus, now that it's phasing out,
Oh yeah. Mhm.
yeah, it's another factor that which you might have to place in service and the rest.
Yeah.
But
Exactly.
but you can go ahead and talk about interest expense as your other category.
Yeah. So interest expense is another category. And then one big thing is real property to the business election, right? For real estate projects, you can elect that one. So you can take 100% of interest, but the trade-off is you depreciate buildings at a slower pace. Like instead of 27.5, you can just 30. So that's something you would need to developers when they set up this financial forecast, they would think, okay, should I take it? Should I not take it? There might be a reason they don't want to do the election. Maybe they want to slow down the depreciation to monitor the 704B capital. We can talk about that.
Right. Well, we'll get to that in a moment here. And obviously these categories, there's other items as well. Interest expense, if you're accruing the interest expense and it's simple interest and doing all the periodic interest payments and all the rest, there's more there in terms of getting the interest expense calculation correctly.
Yeah.
But once again, that'll be part of 201 versus 101. Now let's move into we've got the budget. We've done the kind of the balancing, the sources and uses during the construction development phase, and then also during the 15-year operating phase, if you will. We've talked about the calculation of taxable of net operating income and taxable income or loss. Now we get to the schedules that sort of prove out the losses that you can allocate to the investors. In the purpose of these schedules is that the investor, as we noted, and as we all know, if you're an investor in a locally tax credit transaction and you're the tax credit investor, you want the tax credits, and the allocation of the tax credits follow the allocation of depreciation expense. So you have to have a set of schedules that show the income and loss across years, that also show what your capital account schedule is. And your capital account's broken out into 704D capital, if you will, your tax basis. So you have to have adequate tax basis to deduct a loss. That's generally not an issue. You do also have to have 704B capital. And that's the capital that you have to have for purposes of, a set of regulations that were adopted by the IRS years ago that says if you comply with these set of rules, the loss allocation will be respected. And for tax credit transactions, virtually all, if not all, tax credit transactions rely on the safe harbor contained with these Section 704B capital account rules. And as a consequence, investors will want to see and confirm that the losses will be respected at least during the 11-year period where you're getting tax credits. And generally speaking, they would like it to last the full 15 years. So with that, please share whatever more you want to share about the income and loss allocation schedules, the 704B capital schedule, and then share a few common errors in the times you see developers preparing these, because oftentimes this is the area where the developer will say, I'm going to do a lot of the other schedules, but this I'm going to leave to my accountants.
Yeah, right. Mike had a very good description of the importance of the 704B schedule because the safe harbor rules. So the IRS will respect the allocation of losses. And then so for developers, they would use financial forecast to spot the moment that they would expect the capital would go negative, and then they would plan ahead of time to start negotiation ahead of time with the investors to find ways to make sure the 704B capital, negative capital, will be sustained by a variety of a list of items. So if they identify the issue during the year of the problem, it's probably too late for anybody to fix it. But if they can spot the issue before even they close the deal, they could build in lots of items into the partnership agreement to mitigate the problem. Like they could special allocate losses. If they have operating deficit loans or certain GP loans, they could specially allocate the interest expense away from the investors, so such that the capital is positive to take the depreciation deduction, such that they can take the LIHTC allocations. So, and then they could also insert in like deficit restoration obligation or limited deficit restoration obligation into their partnership agreement to cover certain years when they project the capital to go negative. Or the investor could have other ways to slow down depreciation. Maybe that's one thing they will say, okay, we'll elect out of bonus. Or they're going to say, well, you elect out of bonus for FFE, or we elect out of bonus for side work. So they can have lots of things to plan if they identify the problem early. So this is a very important item for developer to keep an eye on when they prepare the forecast.
No, thank you for that. It's certainly a very critical item. And it's one that oftentimes, we'll get our initial calls from developers when they're dealing with these sorts of questions. And we didn't even use the word minimum gain and non-recourse debt.
Oh yeah, right.
Some of the other items that are embedded in all of these discussions. But I think your advice about identifying it early is the most critical, because I don't think I've ever seen a situation where when you're initially doing the forecast before the investor's in, where you're dealing with these issues, I've not seen a situation where any identified issue couldn't be solved.
Yeah.
Because as you mentioned, there's a number of tools to solve the allocation question. and oftentimes it does mean less losses go to the investor, but that's just the way the rules work, and that'll happen. And I will say that having been involved in these sorts of transactions since 1987, as hard as that is to believe, you said 20 years went fast.
Yeah, right.
Now partnership agreements do a much better job of having, quote, boilerplate provisions that help address these sorts of loss allocation issues that can arise unexpectedly. Because when you're doing the forecast, you project out what you expect to happen and all the rest. And then based on that, you can solve the issues with the loss allocations, but then unexpected circumstances arise. And a lot of partnership agreements have these boilerplate provisions that address how to handle those situations to keep the losses from having to get reallocated such that the credits have to get reallocated. But once again, that's 201.
Yeah.
I won't say any more about that, but it is a critical part. And it's super important for the developers themselves to understand that and not rely on the investors, because the developer's the one making all the guarantees and the rest, which you touched upon tax adjusters and all the rest, but
Yeah.
Developers have a reasonable amount of liability for the full 15 years with respect to these various tax matters. And they want to make sure that they're aware of them and someone within their team is monitoring it.
Yeah. Mike, I just want to mention
Please.
one more thing is about the forecast is not just at the closing. Forecast it should be viewed as a tracking tools, the tracking model. So like especially the 704B capital, I've seen like
Yes.
developers reached out to me, say, can you run tracking model, just put in the actual, replace the estimates, and to see how the 704B capital would look like in 2 years. So I think
Yes.
just want to point that.
Yeah, that's, one thing I said in the intro was the forecasts aren't just about determining initial financial feasibility and the rest. It's also monitoring the ongoing
Yeah.
financial feasibility as well. And part of that are the ability to continue to allocate the losses. And that was where, when I mentioned there are provisions embedded in partnership agreements, or certain provisions about if you end up with unexpected operating losses, how those unexpected operating losses
Right.
should be allocated, which is a way to try to preserve the fact that you want to be able to allocate the depreciation, the credits to the investor. And by doing these schedules, you can help identify that. And I always like as a recommended practice, having that financial forecast that you originally closed on, in the files, and every year comparing actual operations to the forecast. And like you say, if there's anything notable different, update the forecast. But that forecast is something that is a measure of what everyone was expecting. And if what's actually happening isn't what was expected, you should identify those differences, because that might be a signal that some other part of the partnership agreement is kicking in. So thank you, Miao. I really appreciate you being on the podcast, but don't go away just yet.
Sure.
I'm sure listeners will want to contact you. I will include your email address in today's show notes. But I also like you to share with our listeners some of the other resources that we have at Novogradac that will help them learn more about financial forecasts.
So other resources would be like, one is we have the workshop at the conference. We have a special workshop for running the numbers. Look out LIHTC 301. Some of the cases I did those workshop discussions, and also read the Journal of Credit, Tax Credit. And then we have sections talking about running the numbers and financial forecasts, how to gather together the assumptions. And of course, attending our conferences. Yeah. And you can also call one of the Novogradac partners. Call me.
Thank you. Thank you for that. And it also, just to add to that, to consider joining the local tax credit working group.
Right.
That's a group that's headed up by our partner, Dirk Wallace. And we have monthly calls discussing a variety of local tax credit matters. And it's really a good way to learn of items that are on the horizon or recent developments at the IRS that should be incorporated in your financial forecasts. And we like to encourage every tax credit developer client of ours have at least one member of their project management team listening to the calls every month so they can share with others within their company some of the new developments in the long-related tax credit space. So thank you, Miao. Please do stick around for our off mic section where I get to ask you some fun off-topic questions to give you an opportunity to share some words of wisdom with me and for our audience. And to our audience, I want to encourage you to tune in for next week's episode. We're going to talk about a few different issues concerning housing authority-owned properties. And we're going to pay particular attention to the Rental Assistance Demonstration, or RAD program. HUD did publish an important notice concerning the RAD program in July. And we're going to discuss what public housing authorities and others need to know about that notice. We're also going to look at the state of the RAD program today and how things are going with fair cloth to RAD conversions. And if you don't know what that means, that's a reason to listen to the podcast. One other item we do plan to cover is what you need to know about the recent HUD guidance on the use of solar power in HUD-assisted properties. For those of you that are frequent listeners, you probably have already guessed who my guest is going to be. My guest next week will be my partner, Rich Larson. He'll share how the guidance that recently was released makes it easier for public housing authorities to use solar and what that may mean for developers and others. I said that about, you're probably not surprised, because those of you who listen to the podcast regularly know that Rich is one of Novogradac's leading experts when it comes to RAD conversions and other public housing authority and HUD issues. Now, if you have any questions you would like Rich and me to address in that episode, please email them to cpas@novoco.com. Okay, Miao, we now get to turn to our off mic section where I get to ask my guests some off-topic questions so you can provide insight to our listeners. And one question I love to ask guests, and I know I've been asking this before since this is your first appearance, what's the best, or what's one of the best? I always hesitate to say the best, but what's one of the best pieces of professional advice that you've received?
I think one of the best professional advice I received was from Rob, which is the partner when I was a staff at Novogradac, and he told us, like, just keep reading the tax credit journals, keep reading the IRS rules, keep reading the new publications of the laws. Just keep building up the knowledge and skills. I just felt like that's very beneficial because without keeping up to those new rules, we just can't do a good job with the clients.
Yes. No, that's great professional advice. Yeah, you don't know what you don't know.
Yeah.
And by reading, you learn what you don't know.
Yeah.
No, that's great. And for our listeners, that would be Rob Hessman.
Yeah.
One of the sort of very early partners and foundational to the success of Novogradac over the years.
Yeah.
So another question I'd love to ask guests, because I'm a big book reader. I should say book reader and listener. I'm really fond of Kindle. I'm fond of paper, and I'm fond of Audible. So I'm constantly listening to a book or reading a book on paper or reading it on Kindle. And I like different forums for different types of books. And some books I think are better depending on different, mediums, if you will, I find for the different books. But is there a particular book or podcast that you'd recommend to our audience? And feel free to pick one of both, or if you're not much of a podcast listener, just a book, or if you do so much reading and work, you're more listening to podcasts, feel free to just suggest a podcast.
I think I'll suggest a book. So I don't know if you watched the movie. It's a 2019 movie called The Wandering Earth. No. Yeah, it's actually a Chinese movie, but then it was in the theaters in Bay Area. So I watched that one and then liked it, and then so I bought the book and read the book. It's the same name, the book and the movie, it's the same name. And then that was a very interesting book. It's talking about because people are polluting or didn't taking care of the Earth's environment, such that the environment of all the solar system got so bad that people have to send the Earth to another solar system to save the lives. So I think that's kind of interesting because it's tied to what I work on lots of renewable energy deals. I just feel like it's the importance. Well, it's eye-catching if we don't take care of the Earth. Starting from now,
Okay.
I don't know, in a couple of generations, it will have consequences. Green energy.
So Wandering Earth, that's both a book and a movie recommendation,
Yeah.
sounds like.
Yeah.
Okay. You went off script. I love it. A book and a movie recommendation. So, and you would recommend the movie first or the book
Yeah.
first?
Movie first is on Netflix.
Okay. So I will add that to my Netflix and I'll watch that and I'll add the book to my reading list.
Great.
So thank you, Miao. And for our
Thank you,
listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.